Hello and welcome. I'm Perrin Desports, one of the founders at Tusk Partners, and I'll be your host for this webinar. This is a two-part webinar series that contains some of the best content taken directly from our DSO fundamentals teaching decks. All of us at Tusk appreciate your time and interest, so let's dive right in. A few quick housekeeping issues before we get started. Hopefully you just received an email from me. In that email, it contains a download link for this entire deck that you're about to see. I recommend that you pause the video now and check your email inbox or your spam filter. Assuming that you got it, click on the link and download the deck. This will allow you to take notes, scribble in the margins, make comments, and anything that you want to follow up on. You can also pause, rewind, fast forward the video anytime that you want to. These webinars are a two-part series, and we've broken them down to try to make it easy in terms of file download sizes, and they should each last about 20 to 30 minutes. You can watch both of them back to back or at separate occasions. This is obviously a video of a webinar series, but I still encourage you to ask questions. You can email us at any point in time, and I'll give you all of our contact information about how to reach us. But feel free to ask anything that we cover in this deck or in the upcoming second webinar series, or anything you would like about the DSO industry in general. We're here as a resource for you, and we hope that you'll reach out to us often. So the two webinars in this series are basically, the first is Dental Industry Trends, the emerging middle market DSO space. It's an overview of what got us to where we are right now. The second webinar is more DSO fundamentals, including private equity, valuation drivers, and what we think is going to be happening in the coming years as it relates to the business and practice of dentistry. I'll start by giving you a quick overview of exactly who we are and what we do so you'll understand a bit more about our background. That's me in the middle. I'm Perrin Desports, and those are my two partners, Diwakar Sinha and Kevin Cumbus. Kevin got his start in investment banking with Wachovia Securities. After business school, he spent 4 years with the McGill Hill Group here in Charlotte, North Carolina, focused on practice transitions and valuation. After leaving the McGill Hill Group, he did 4 years with Affordable Care Incorporated in their DSO operations and roll-up strategy. Diwakar is the banker in the group. He spent the last 15 years of his working career lending money to dentists all over the United States. Most recently, he was Vice President of Sales for East West Bank out of Pasadena. East West was the preeminent lender in the emerging market DSO space of dentistry. And I've got 15 years of distribution experience, having run 3 different operations for Patterson Dental Company. There are 2 facets of our business here at Tusk. The first is an online brokerage website. Think Zillow.com meets dental practice brokerage. Until now, if you wanted to sell your dental practice, you basically had 2 options. You can pay a broker 10% to sell your practice, or you can go it alone and do it in a for sale by owner model, neither of which are a really good value proposition. We leverage modern technology to reduce our costs and pass those savings on to our sellers, and we charge 5% commission to do that. You'll see that our listings feature beautiful professional photographs, informative graphical displays of clinical, financial, and operational successes, and much, much more. We think more engaged buyers hopefully means more offers and potentially a higher selling price for our sellers. It's a wonderful value proposition. You can see more examples of our listings and get further details at tuskbrokerage.com. The second facet of our business, and really what we're going to dive into more tonight, is on the Tusk Partners side of the business. This is focused more squarely on group practices and DSOs, especially those in the emerging market. Think 5 to 25 locations. Your legal structure is critically important, and you need to define it early on in your DSO because it impacts equity and exit considerations as you scale your business. Debt structure is something that not too many emerging market DSOs consider until it's too late. Traditional lenders typically pull back around 4 locations and roughly $2 million in debt exposure. So we help them find alternative sources of capital. You can learn more from our white paper on our website called Debt Financing in the Emerging DSO. We offer buy-side advisory services and sell-side advisory services. Most DSOs will grow through acquisitions, so they frequently come to us and ask them to find targets to acquire. Then we do some quantitative modeling to determine the upside of the acquisition as it fits within their DSO. On the sell-side advisory, this is really more of a go-to-market strategy. It's about a 3 to 6 month process where we prepare the business for sale operationally and financially, trying to show it in its best light. And then we take it to market to find the best partner or acquirer, be it private equity or an enterprise level DSO. To go from small to medium to large takes a little bit of hand holding, and our strategic consulting offering is geared toward that end. Our engagements typically last about 6 to 36 months, and they're designed to help a DSO grow and scale their business to the point of preparing for a sale. You can find more information about these services as well at tusk-partners.com. So now that you know a bit more about who we are and what we do, let's take a quick recap of what we covered in our first webinar, Dental Industry Trends, the emerging middle market DSO space. First of all, we sized up the practice of dentistry and the industry overall. We talked about the 6% compounded annual growth rate forecasted for the future and how that was at about twice the macroeconomic average of GDP overall. It made it a very enviable space for private equity and a lot of other investment. We talked about what it takes to build and scale a DSO and why DSOs are valued in the way that they are. We discussed what EBITDA stands for and what multiples of EBITDA are. And finally, we talked about a private equity investor in our DSO platform and how they in turn improve the practice over a period of years and then turn around and sell it on the back end for themselves, making an even higher multiple. The numbers can be pretty staggering, but there's no mystery why dentistry is such an attractive business to so many people at this current point in time. So now we're going to dive deeper into private equity, valuation drivers, and what's coming in the next several years as we finish out our DSO Fundamentals webinar. You really can't talk about group practice and DSO nowadays without knowing what the term private equity or private equity group, or PEG, means. But all too often those terms get thrown around pretty loosely, and I find that not too many people are exactly sure what private equity truly means. Private equity, or a PEG, is a group of individuals that have assembled a fund of investable dollars. The dollars come from institutional investors or high net worth individuals, usually in the hundreds of millions of dollars. They form a company or a fund to invest those dollars. Usually the operators of the fund have industry sector experience. They have a background of working with people or working in the industries that they're interested in investing in. They have inside knowledge and they think they can create value where they find opportunities. Typically the funds themselves last about 10 years, and they're broken down into the first 5 years and the second 5 years. The first 5-year term is typically when the operators of the fund are looking for companies to invest in. Those companies are typically portfolio companies. They're the ones with brand names. They want to expand it and build off of it. After they find those portfolio companies and they make subsequent acquisitions to bring them in-house, they manage those companies for a number of years and then they sell them on the back end. Typically, a private equity group or private equity fund has an objective to create 3 times returns or triple the value of the money that was put into the fund, and exit it over a 10-year period. So tripling your money over between 5 to 10 years of a time horizon. Typically, the returns of private equity groups are generated several ways. They buy companies at reasonable prices, even though some of the numbers that we threw around in our first webinar would lead you to believe otherwise. They're very disciplined investors, and they only invest where they know that there's an upside. They improve portfolio company operations and increase profits while mitigating business risks. They expand corporate governance and infrastructure to support that growth. And then they build scale and efficiency with bolt-on acquisitions and other capital growth investments, meaning they take a business from 1x to 2x over a period of relatively short time. Then they successfully sell the business at a higher valuation than they bought it. Again, their return expectations are about 3 times over a 5-year period. So as it relates to dental and dental practices, or a DSO platform, what are private equity groups typically looking for? Well, they want proven and experienced management and leadership with skin in the game. Skin in the game is defined as equity or ownership. Some of the clinical factors they're looking for are the obvious ones: skilled providers and low provider turnover. They want high standards of clinical care and high rates of patient satisfaction. They also want compliance protocols in place and an enforcement mechanism to adhere to. They typically want a diversified provider mix with some specialty care component, and they want attractive and diverse payer mixes with stable reimbursement rates. Along the business factors, they need strong operating metrics. These are your day-to-day metrics that everybody pays attention to, like visits, revenue per visit, recall rates, new patient counts, and the like. Typically, financial reporting and metric tracking are things like growth and margins and profitability and obviously cash flow. They want an established history of growth. It doesn't matter if it's organic growth and de novos or any types of acquisitions you may have made. They want scalable platforms that have significant upside and the infrastructure to support growth. The upside opportunities and financial projection for visibility are key going forward. Competitive differentiation is also important in terms of the value mix of the business, and they want regional market leadership. In our prior webinar, we talked on several occasions about platforms and what a platform is, and it's basically consolidating or centralizing services. You can think of that 2 ways, clinically speaking and from a business standpoint. This slide does a nice job of explaining clinically and from a business standpoint what exactly can be centralized at some point in time for the growing DSO. The typical process for a private equity group to acquire and then divest of the DSO is pretty much as follows. You spend about a 3 to 9 month continuum in terms of selecting and sourcing the candidates for acquisition. After you find what you're interested in, they produce a letter of intent. There's a due diligence phase where they take apart numbers after numbers, and then legal documents and executing the deal come at the very end of that 3 to 9 month period. The next 100 days are going to be spent under new ownership, and then there's going to be monitoring with growth and efficiency expectations as you scale the business over the next 4 to 6 years. And about at the end of that time is going to be the exit strategy, where they execute selling the business to a larger investor or a larger platform itself. Private equity buyers think about valuation sometimes differently than you and I do. They have expected rates of return as it relates to transaction multiples, growth opportunities, and obviously exit potential. And there are multiple factors that impact those transaction multiples. Market, company, process, and methodology are several. Every now and again you hear about people tossing around different multiples and different ranges for seemingly the same business. And you really scratch your head and say, how can that actually be? Well, it kind of depends on multiple of what. If you have, in this example, if you have a $50 million valuation and the valuation is a multiple of prior year EBITDA, and if your prior year 2016 EBITDA was 5 million, that's a 10 times multiple. 50 million is 10 times 5. On the other hand, it's only an 8.3 times multiple if you consider last 12 months trailing EBITDA as of March. In this example, 6 million metric of EBITDA is 8.3 times multiple to get you to $50 million. And you can see and so on and so forth. So what might the future look like for us in the dental industry? What's the coming decade going to look like? We showed this slide in our first webinar, and we talked about the middle market being the fastest growing space in the practice of dentistry, but we said that there was a story behind this story. Now's maybe the time to tell the story. You can break down dental practices into basically 3 buckets. If the ADA average for a general dental practice is roughly $650,000, you can look at those practices below $650,000 in revenue, then the bucket of those between the average, $650,000 up to about $1.25 million in revenue, and then those that are above $1.25 million in revenue. Those that are at or below the 80 average are seeing low demand from buyers. The reasons for this are really twofold. There's not enough production to support any more than one provider, and sometimes they don't throw off enough cash to support a new buyer, even if it is a solo buyer. These practices are typically below a DSO's radar in terms of acquisition because it takes too much time and effort to bring them up above the magical $1 million mark. On the other hand, the practices that are above $1.25 million on the bottom also carry some risk. There's provider risk. Sometimes these practices are dominated by a super producer, somebody who is very fast and very efficient in providing dentistry. In short, they can churn out a lot of work. That's great. Or maybe they're doing exotic procedures. We call implants, basic ortho, airway management, things along those lines as being exotic procedures because they're not necessarily bread and butter dentistry. Yes, they're more common, but they're not 100% commonplace. In these practices that are above $1.25 million in revenue, the success of the practice is all too often situated on a super producer or someone doing exotic procedures, or both. If that provider leaves the scene, what type of business is left? And therein lies the risk. On the other hand, the straight down the middle $1 million practice is everybody's bread and butter. And we're going to show that it's the practice that everybody wants to buy. Dental industry's sweet spot is that $1 million revenue practice. The ADA average is roughly $750,000 in revenue, but that takes into account specialty practices as well. The ADA average for a general dentist is about $665,000 as of 2015. So let's take a look at a typical young doctor who's interested in purchasing his or her first practice. What do they look like? Well, a typical dentist profile is a household of 3. We said in our first webinar that a lot of dental school graduates are carrying in excess of $300,000 of school debt with them. That at a rate of 5% in a term of 20 years, that's a monthly payment of about $2,300. They typically own a home. Mortgage is maybe $450,000 at a rate of 4% over 30 years is about $2,500 on a monthly payment. And if they have a couple of cars, nothing extravagant, they probably have it at a rate of roughly 2.6% over a 4-year term, or a little bit over $1,000 in monthly payments. For a household of 3, a bank is going to estimate monthly living expenses in the realm of about $1,000 per individual. So $3,000 for this family of 3. You add up all of their fixed monthly payments along with their living expenses, and you get a total monthly living expense of a little bit over $9,000 or almost $110,000 annually. If this person is currently employed as an associate, they're probably making about $150,000 gross. They pay 25% in taxes, and their net income is about $112,000, barely clearing their living expense, but not allowing for much savings at all. So what does that average ADA practice look like? If it generates $775,000 worth of revenue, it has a net adjusted income percentage of about 32%, meaning it's got pre-tax owner cash flow of about $248,000. A typical practice of this size would probably sell for about $600,000. That's 77% of revenue. Whoever buys it's probably going to need a little bit of working capital to spruce up the place, so the total bank loan's probably going to be about $650,000. At a current interest rate of 5% and a term on the loan of 10 years, you're looking at a monthly payment of about $6,900, or annual debt service of almost $83,000. If you subtract the $82,800 in debt service from the $248,000 pre-tax owner cash flow at the top there, you're left with $165,000. You pay 25% taxes on that, and your net income as the owner of the new owner of the practice is almost $124,000. So trying to buy this average ADA practice by a typical young associate buying their first practice, this is what it looks like from a banking perspective. We said those total monthly living expenses were a little bit over $9,000. Their annual living expenses being about $110,000. The net taxable income from the practice we just looked at, the ADA average, and after taxes are paid, leaves a net income number of almost $124,000. A bank looks at something called a debt service coverage ratio to determine whether or not this is something that they want to loan money against. And in this scenario, they have a minimum debt service coverage ratio of 1.2. Your debt service coverage ratio is simply your net income divided by your annualized living expenses. In other words, do you clear enough in post-tax income to pay your debt obligations with a little bit of buffer? And in this case, 1.13 on the debt service coverage ratio is below the bank minimum of 1.2. So the average ADA practice generating $775,000 in revenue doesn't throw off enough net income to a new owner for the bank to loan them the money to buy it. Well, if it doesn't throw off enough income, we probably need to look further upstream. Let's look at $1 million practice to buy. What do those numbers look like? Well, here's your $1 million in dental practice revenue at a 32% adjusted income percentage, means pre-tax owner cash flow of $320,000. This practice is going to sell for about 75% of revenue, or $750,000. Again, you're probably going to need working capital for a total bank loan of about $825,000. If you finance it at 5% over the same 10-year term, That's about $8,750 per month in terms of a monthly payment, or $105,000 in annual debt service. When you take the annual debt service of $105,000 and you subtract it from that pre-tax owner cash flow of $320,000, you're left with net taxable income of $215,000. You pay your 25% in taxes and you clear $161,250 in net income. If we use the same example as before, with the minimum debt service coverage ratio of 1.2, you can now see that the $1 million practice throws off enough net income to our new purchaser to qualify for the loan. So in an odd way, the bank wouldn't loan them money to buy the less expensive practice simply because it didn't throw off enough cash flow. They're a lower risk and a better borrower to borrow money on the $1 million practice. So based on the average debt load, the typical young doctor cannot afford to buy the average dental practice today. They basically have to buy the $1 million practice that is the industry sweet spot. A DSO is also most interested in the $1 million practice due to revenue, profitability, minimum provider or procedure risk, and still a lot of potential upside. So now we're in a case of supply and demand. How many $1 million practices are in the market for sale, and who would be willing to pay more for that $1 million practice? A typical young dentist or a DSO? Well, let's take a look. Here are some seller options. The $1 million practice. You're going to sell your $1 million practice. It puts off clinical production of about $700,000 and hygiene production of $300,000. You have an overhead rate of roughly 60%, so benefit to owner is $400,000. This practice, if sold through a broker, is probably going to be valued at roughly 80% of revenue, so it's going to sell for about $800,000. And if you're a young dentist buying out a senior dentist through a bank loan, you're going to write them a check at closing for $800,000. Not a bad day for senior seller to walk off with $800,000 in their pocket. But what does that look like from a DSO perspective? Well, a DSO is a little bit different, and they're willing to offer a little bit more at the point of close. Specifically, a DSO is probably willing to offer more like 100% of revenue, meaning the full $1 million for a $1 million practice. Here's how they're going to structure it. They're going to give the seller $800,000 cash at closing, and they're going to defer 2 $100,000 earnouts in year 2 and year 3. They want the seller to stay on board. They want that good transfer of goodwill. They want the patients to stick. They want the staff to stay on board. They want to maintain the business as a going concern without any disruption. They want the current owner to work in the business for as long as they want, but for a minimum of typically 3 years. Now, when the owner sells the business to the DSO and agrees to work for 3 to 5 years, of course, he or she is going to get paid for that clinical production. This year, the $1 million practice generated $700,000 of clinical production, and our seller got paid $210,000 for his or her clinical production. They also earned benefits. When you add their clinical compensation with their benefits and the $800,000 they got at closing for the sale of their practice, they netted over $1 million in year 1 working for the DSO. In year 2, the DSO is going to ask that you increase your revenue by some amount. We said 5%. That 5% trickles through this entire example, and at the bottom, they get paid clinical compensation. Now the employee, the former seller, gets paid clinical compensation of almost $221,000. They still get benefits. Oh, and because they met the production criteria, they get their first $100,000 installment from the original sale of the practice. They take home $353,000 in year 2 working for the DSO. Year 3, it's much the same. Grow at 5%, get paid your clinical compensation based on production, they get paid benefits, and they get the second $100,000 installment for a total take-home of $366,000. As long as they're an employee in good standing and continue to do good work, they can work indefinitely. So in this case, our seller works year 4 and gets paid for that, and works year 5 and gets paid for that. And when you look at a total 5-year earnout, our seller sells his or her $1 million practice for over $2.3 million. Now, which would you rather have, $2.3 million or $800,000 in a walkaway? More than likely, these $1 million practices are going to be sold to DSOs because DSOs are willing to pay more, and the senior seller has the option of staying on and not having to take mandatory immediate retirement. The practices that are in the dental industry sweet spot are going to be fewer and fewer in number as the supply dwindles. They're going to be highly coveted for purchase, meaning they're going to be in high demand. And most are going to be acquired by a DSO because they can simply afford to pay more. So the consolidation is just getting started. And based on the lack of better alternatives, outside money will continue to come into the industry that we all know and love. The investment returns are going to continue to be incredibly favorable for quite a while. We should all expect to see more consolidation of services and practices going forward, for the example that we just worked through. We should also expect the overall speed and the rate of change to continue to increase. So we thank you for joining us for both webinars, and we hope you've learned a lot. I'm sure that we've also created a lot of questions. There are ways that you can stay connected with us. If you think you've got a friend or a colleague that would benefit from this webinar series, let us know by clicking on the link ahead of you or in your PDF that you downloaded, and we'll send them the link to both webinars so they can view it as well. If you want to continue to grow your knowledge of the DSO space, our blog's a great way to do that. You can subscribe here. And if you're looking for an industry expert to provide DSO-related content for a seminar, trade show, customer event, study club, or even for a remote hosted webinar, we do that frequently and are happy to help you out. We can also co-author any content for your trade publication, blog, white paper, ebook, or otherwise. You can download our PR packet with speaker information from your PDF deck as well. But if you have questions about this particular webinar or anything else related to the DSO industry, we hope that you'll reach out and touch base with any of us directly. Our contact information is right in front of you now, Kevin, Perrin, and DeWalker, and you can reach us all on our cell phones or directly in our office. All the best. Thank you so much for your attendance. We appreciate you being with us.